Most people don't realize they're losing the game until they've been playing it for years. They do everything they're told to do. They pay on time, they avoid late fees, they follow the rules. And yet, somehow, the balance barely moves. Month after month, the statement arrives, the payment goes out, the confirmation appears, and still the number sits there, almost unchanged, almost mocking. This is the quiet frustration millions of people live with, especially across middle-class households in the United States, the United Kingdom, Canada, Germany, and Australia. People who work hard, people who budget, people who genuinely try to be responsible with money. The problem isn't that they're careless. The problem is that the system they're using was never designed to let them win easily. Credit cards are often described as tools, neutral, optional, harmless if used correctly, but that framing hides a deeper truth. Credit cards are financial products engineered around a very specific outcome: long-term, predictable debt that generates interest for as long as possible. Not chaos, not collapse, control. To understand why credit cards keep so many people trapped, you have to stop looking at individual behavior and start looking at incentives. You have to stop asking why people struggle and start asking why the struggle is so profitable. At the beginning, credit cards feel helpful. They solve problems instantly. They remove friction. They smooth out life. A repair bill arrives earlier than expected. Groceries cost more than planned. An emergency shows up without warning. You don't need to panic. You don't need to delay. You just swipe. And nothing bad happens right away. That's the first psychological hook. Credit cards separate the action from the consequence. The pain of paying is delayed, reduced, and fragmented into small future moments that don't feel urgent. Human beings are wired to prioritize the present. We respond to immediate discomfort far more strongly than future cost. Credit cards exploit that wiring perfectly. They allow relief now in exchange for pressure later. Pressure that grows slowly enough to feel manageable, but relentlessly enough to become permanent. This delay is not a side effect, it is the feature. The second hook is subtle but far more powerful: the minimum payment. When your statement arrives, it doesn't demand the full amount. It doesn't insist on urgency. It doesn't create panic. Instead, it offers reassurance. You only need to pay this. The number is small, almost friendly, almost comforting. Psychologically, the minimum payment does something important. It reframes debt as a monthly subscription rather than a growing obligation. It tells your brain, this is under control. But the minimum payment is not designed to help you get out of debt. It is designed to keep you inside it. To understand why, you have to understand how interest actually works. Credit card interest is not charged once a year. It is not even charged once a month. It is charged daily. Every day your balance exists, interest is added, even when you're not using the card, even when you're actively paying it down, even when you believe you are being responsible. This means time is the real cost of credit card debt, and time is exactly what the minimum payment maximizes. When you pay only the minimum, most of your money goes toward interest, not the balance itself. The debt remains largely intact, quietly generating more interest the next day. From the bank's perspective, this is ideal. From your perspective, it feels like running in place. Consider a simple example. You owe $1,000 on a credit card with an interest rate of 24%. Your minimum payment is $20. You pay it. You feel relieved. You move on. But that month, interest may have added $15 to your balance. That means only $5 of your payment actually reduced the debt. Next month, the same thing happens. Over time, you realize something unsettling. You are paying regularly, but escaping slowly, if at all. This is not a failure of discipline, it is a consequence of math. Now add real life into the equation. Life does not pause while you pay down debt. Costs rise, emergencies appear, salaries stagnate. Unexpected expenses don't ask for permission, and because the credit card is always available, it becomes the default solution. One more swipe, one more charge, one more month of delay. Every new purchase doesn't just add to the balance, it resets the interest clock, it extends the timeline, it increases the amount of time your money will be spent servicing interest rather than reducing debt. This is how balances grow without dramatic events, not through recklessness, but through repetition. Over time, something psychological begins to happen. People stop thinking in totals, they start thinking in payments. The question shifts from how much do I owe to can I afford this month's payment? That shift is incredibly important. It transforms debt from a problem to be solved into a condition to be managed, and once debt becomes a condition, it can last indefinitely. This is where credit cards stop being tools and start becoming environments. Credit card companies understand this deeply. They do not want customers who pay off balances immediately. Those customers generate very little profit. They also do not want customers who default completely. Those customers generate losses. The ideal customer is someone who carries a balance, pays reliably, and feels just enough pressure to stay engaged, but not enough to escape. This is not about morality, it is about incentives. The system rewards longevity, not resolution. This is why credit card marketing focuses so heavily on convenience, rewards, and flexibility, but very little on interest, timelines, or total cost. It is why statements highlight the minimum payment instead of the long-term consequences. It is why credit limits increase when you prove you can carry debt responsibly. Responsibility in this system means consistency. From the outside, it looks like progress. Payments are being made, accounts are active, nothing is technically wrong. But internally, the system is working exactly as intended. Debt is stable, interest flows, the treadmill keeps moving. Eventually, many people internalize the struggle. They assume the problem is personal, a lack of discipline, poor planning, bad habits. This self-blame is powerful and convenient because when people blame themselves, they don't question the structure. They don't ask why a product designed by financial institutions consistently produces the same outcome for millions of users. They assume it's just them. But the truth is uncomfortable. If a product repeatedly produces long-term debt across different countries, income levels, and personalities, then the product is not failing, it is succeeding. Credit cards are designed to stretch repayment over time because time generates profit. Every additional month a balance exists is another month of interest, another month of predictability. This is why minimum payments exist. This is why interest compounds. This is why clarity is optional. Transparency would shorten timelines. Shorter timelines reduce profit. This does not mean credit cards are inherently evil. It means they must be understood clearly. A credit card is not a bridge. It is a loan with friction disguised as convenience. And like any loan, it transfers future income into present spending at a cost. Breaking out of credit card debt does not require perfection. It requires alignment. The moment you pay more than the minimum, the system changes. Interest loses power. Momentum begins to work in your favor instead of against you. But more importantly, your mindset shifts. Debt becomes something temporary again. Another critical realization is understanding the difference between access and ownership. A credit limit is not money you have, it is money you are allowed to borrow. This distinction seems obvious, but it is rarely felt emotionally. Credit cards blur that line intentionally. They make borrowed money feel personal, familiar, yours, until it isn't. When people finally escape long-term credit card debt, they often describe the same feeling: clarity. Not wealth, not freedom yet, just clarity. The absence of constant low-level pressure, the disappearance of background anxiety. This clarity changes behavior naturally. Spending slows, decisions become deliberate, financial choices regain weight, not because of discipline, but because the fog lifts. And that's the real cost of credit card debt. Not just money, attention, mental space, years of quiet stress that feel normal only because they are common. The system does not need to trap everyone forever. It only needs enough people to stay long enough. That is how it sustains itself. Once you understand this, credit cards lose their mystique. They stop feeling like safety nets and start feeling like what they are: financial